What's up everyone, it's Karthik with MoneyVest. So it's a new month, August 1st is officially here. It's a new take on the markets because we are seeing a lot of individual stocks starting to roll over a little bit here on the day. Not only that, we are seeing small caps also selling off on the day. So a lot of people were asking me questions about why that might be happening. I mean, small caps are down a whopping 3% on the day. I mean, you can take a look at this candlestick, which is just absolutely selling off aggressively, with the NASDAQ now down almost 1%. There has been a little bit of a rotation to the downside because we did start off the day with green. If you come over to the 5-minute chart, you'll notice that we have seen a pretty reasonable sell-off starting 9:50 a.m. Eastern. So this has been a over 2% sell-off in the NASDAQ, with the S&P 500 also. Take a look at that sell-off, folks. I mean, we are just seeing a lot of volatility, a lot of back and forth here, down about 1.5%. And in this video, I'm going to break down exactly why I believe that is. Why are we seeing a selling pressure across the board for large caps, big tech, small caps, S&P, NASDAQ, everything starting to see a bit of a pullback here on the day, with the Dow Jones also down about 1% on the day here. So from its highs of July 31st of well over 41,000, it is down almost 2% as well. So as always, if you enjoyed this video, find it helpful, make sure that you drop a like, subscribe to the channel. Again, links to our Discord and Patreon is going to be down below. We're adding a few more features that I'm going to be announcing very soon. So love to have you on board. The first week of the month is the best time to join. You can get a 16% annual discount that I'm keeping open for another few days because a lot of people wanted to join. They commented in my YouTube videos. So if you want to join, link's going to be down below. You can get access to my members only private videos with over 37 stocks and ETFs that you can keep track of with their buy targets, as well as all the trade alerts and trade ideas as well for options alerts, and of course regular trade alerts as well. Link's going to be down below. We'd love to have you on board. So first things first, I was listening to this big take from 3 days ago, Wall Street's big take and Wall Street's great rotation, right? There seems to be this big idea that everybody is starting to rotate into small caps, as Tom Lee's kind of leading in that direction. He's been very bullish on small caps. I've done a couple videos on small caps myself. I am up on that position. I own small caps, full disclosure, so I am very much in the green for that position. So I like that area of the market. However, what I do believe what is going on right now is a rotation out of small caps, out of big tech, out of everything, and money is moving towards bonds, I feel. Because we are seeing TLT actually rally quite aggressively. So this is perhaps one of the only section of the market today which is up, TLT and TMF. I mean, TMF, of course, being leveraged ETF. It is pushing higher, up over 3% on the day, with TLT also pushing up almost 1% at one point during the day here. And sometimes, right, when I show you guys the heat map over here like this, it kind of gives us an idea of, okay, what stocks are moving higher, where the money's moving to, right? So, for example, Meta, post earnings, doing really well, still up 5 to 6%. Eli Lilly, Microsoft, pushing up 1 to 2%, nothing crazy, but most stocks are down. But it also helps to understand the movements of ETFs, exchange traded funds. And these are the ETFs heat map. And what you'll see is what's green on the day are mostly inverse ETFs. So for example, SQQQ up almost 2%, of course, on the back of NASDAQ selling off. We have SOXS in the corner, so you can see SOXS up a little bit over 11% because semiconductors are selling off. So if you come over to my semiconductor watch list, you'll notice that semis are across the board just straight up red. I mean, there's so much red here in semis, with Lam Research down over 7%, Qualcomm down over 7.7%, Applied Materials down 6%. So there's just incredible amounts of selling pressure, with SMH down over 3.5%. So of course, SOXS is pushing higher. TZA, that's the inverse of small caps, TNA. So TNA is the leveraged section of small caps. So TZA is pushing higher, which is the inverse of small caps. And RWM, I believe, also is the inverse of small caps. So short Russell 2000, that's RWM, which is up a little bit over 2.9, almost 3%. So apart from the inverse ETFs pushing higher, what else is green? You can take a look at volatility. So VXX, UVXY, all of them are up because volatility is back up over 7%, right? So back up to over 17.5. But I really want you to pay attention to this small section of the market where money is moving into, which is fixed income, right? So if I zoom in a little bit, fixed income is also where money is moving into. So TMF, for example, TLT, for example, IEF, TIP, government, even mortgage-backed. If you come over to our bonds watch list, it's going to be a little bit up here. So bonds, you'll notice that it is mostly green. TMF, TLT, IEF, which is 7 to 10 year Treasury bond ETF, LQD, which is investment grade corporate, and VRIG, variable interest rate investment grade as well. So those are the ones that are actually getting a lot of liquidity inflow and are pushing higher. And what might be the reason for this, right? I mean, we had the FOMC yesterday, right? That could be a reason, right? Why the markets are a little bit more interested in getting ready for buying bonds, right? Because they want to lock in yields that are still at a historical high. I mean, if you come over to the money market funds, right? So this is something that I wanted to break down in today's video is total assets in money market funds, right? So if you search for this, you're going to come over to this very simple page, $6 trillion, right? As of July 3rd, $6.15 trillion. If you come over to the release from the Investment Company Institute, so ICI, come over to this specific page, it's going to show you a breakdown of what is the current assets in the money market funds. And right now we're sitting at $6.14 trillion in total assets sitting in money market funds, of which institution is $3.66 trillion. So when you have a yield curve that is, of course, uninverting right now as we speak, you can see that we're very close to turning into positive territory here. And at the same time, the US 10-year treasuries are selling off like there's no tomorrow. If you come over to the daily chart, just take a look at this selling pressure on the 10-year treasuries. We are seeing consistent lower highs and lower lows, and from its recent highs from back in July 25th of 4.3%, it has already dropped over 7%. In other words, 31 basis points drop. A lot of folks, a lot of institutional investors, a lot of large cap pension funds, government funds, sovereign funds, hedge funds, they're going to want to lock this 10-year treasury rate in. And that's why they're getting more and more it's kind of like a race to the bottom, right? Because you want to lock these yields in because they're historically higher than usual. And for the reasons which we're going to discuss now, because the markets are anticipating rate cuts. If the markets are anticipating rate cuts, well, guess what? Yields are going to continue to come down, and that is going to be less guaranteed returns for institutional investors that, again, are holding on to over $3.6 trillion in total money market funds in assets. So this right here is market's expectation for interest rates. As you can see that first rate cut expected in September. So the next meeting, we are expecting a rate cut, 80% probability that the Federal Reserve is going to lower interest rates by 25 basis points. And there is a 19.5% probability that we're going to get a jumbo cut of 50 basis points and bring rates down to sub 5%. And then, of course, by November, 71% probability that we're most likely going to be there at around 4.25%, 4.75%, and 5%. And then by December, the markets are pricing in a 66% probability that we're going to be sitting somewhere between 4.5% and 4.75%. And as interest rates on the federal funds rate comes down, well, guess what? The 10-year treasuries, 2-year treasuries, the entire curve is going to start rolling over because that's how it works. So as interest rates continue to come down, I think investors are going to get a little bit more angsty with kind of locking in these rates because, like I said, there's a lot of capital sitting in money market funds earning next to nothing, where you've got 10-year treasuries, which at one point was yielding 4.7%. That's almost a 100 basis point reduction. If you come down to, let's say, 3.7.5, that's going to be almost 100 basis points or 1 full percentage point decline, which on assets worth over trillions of dollars is a lot of money, right? And this is backed by the U.S. government, right? So the U.S. debt, of course, being the highest graded debt in the world. So that is sort of my estimates as to why I feel there's a rotation coming out of most parts of the market, almost all parts of the market. And of course, inverse ETFs are up. And the only bullish sector that is green is the bond market. It's the fixed income, it's TLT, TMF. And those are the sectors that are seeing a lot of liquidity flooding into them because of the rate cuts that are now expected from the market. Now, one more thing I want to mention is that this is a very flight to quality trade. This is a trade which is markets are repositioning a little bit more risk averse, right? Markets are positioning themselves to be a little bit more defensive. And the reason I say that is because equities tend to be risky. Doesn't matter it's large cap or small caps. Equities in general tend to be more risky. And the fact that the money is rotating into bonds is just one of those market signals that we are repositioning a bit more defensively, because rate cuts in the past have often come at times of recessions, times when the Federal Reserve foresaw a recession or they foresaw some type of economic downturns and weaknesses. So Fed announcing rate cuts means recession is coming and the market will cool down, and that's why there could be some rotation into bonds because of that risk-averse nature or defensive nature from the market. Now this time we are a little bit different. I mean, we're not seeing any type of recession indicators. I mean, the economy continues to be strong. We are still seeing unemployment really low. Economic growth is still decently up, and inflation is heading towards the sustainable 2% target the Federal Reserve wants it to be. But if we get a September cut, yes, this time is going to be a little bit different because every time in the past we have seen rate cuts come on the back of a potential recession already in play, as shown in that chart. As you can come back here, you'll notice that recessions have followed every time the Federal Reserve has cut interest rates going back as far as 1990s. So this right here, rate cuts, that red zone is the recession. This right here was the rate cut. We again had a financial crisis. This right here, rate cuts, we had a COVID crisis. And this is sort of like the red zone that we are marking now. Are we going to see a recession or not if the Federal Reserve actually starts lowering interest rates? Let me know in the comment section down below, because that in the short term obviously is not going to be good news for the markets in general. And this right here was from the Kobayashi letter. I've never been able to pronounce their name. I do apologize. What has happened historically when the Fed started cutting interest rates? Interest rate cuts conducted outside of recessions have been bullish in the past. So since 1950, if the economy did not experience a recession within a year, while the first Fed cut of the S&P 500 was always up 3 and 9 months after. Stocks also recorded positive returns 6 and 12 months after the first cut, except for 1986. And since 1950s, the S&P 500 saw an average gain of 10% in the 3 months after the first rate cut without a recession. A soft landing is crucial for stocks, and this right here is the returns of the S&P 500 when we did not see a recession. Again, the key word here is when we did not see a recession after the first Federal Reserve's rate cut. So the idea here is very much dependent on whether we're going to see a rate cut accompanied with a recession or not. If we don't see a recession and we see a rate cut, then historically speaking, the markets have seen that as a very positive quantitative easing environment, and stocks do rip 3, 6, 9, 12 months later. But if that accompanies a recession, then short-term volatility and short-term pain is still going to be there. And maybe that's what the market's starting to sense a little bit and could be positioning defensively into bonds. That's where the liquidity is going, at least today. But either way, I want to be very clear. Either way, it doesn't matter what happens. When the markets do give us that opportunity and they do start selling off, that's going to be buying opportunities for us regardless. I will continue to dollar cost average. I will continue to be very vocal about why there's good opportunities here, why the risk reward is really good. And I will continue to deploy capital into the markets, and we'll continue to update and send out alerts in our Discord. So that will continue. I'm trusting the process and I'm sticking to the plan, and I'm not going to divert away just because there could or could not be a recession in the future. So that's, I think, the really, really important message here, and wanted to give you a bit of an update on why the markets are moving the way they are today. Liquidity coming out of big tech, small caps, and moving more towards the bond market and fixed income. That's market's way of telling us to be a little bit more defensive on the day, of course, if this trend continues, and moving forward as well because of the rate cuts that are now being priced in. And rate cuts now priced in, a couple reasons I already mentioned, as institutional investors are now going to see a bit of a race to the bottom for the 10-year treasuries, for the yield curve in general, as interest rates continue to come down. And the second reason could be that defensive positioning from the market on the back of a potential recession that may or may not happen. So let me know in the comment section down below, do you believe that there is going to be a recession in the US moving forward in 2024 or not? I really have to kind of see the unemployment data. So that's coming out tomorrow. If that continues to accelerate, if unemployment rate continues to go up, then of course we're going to be in a bit of a trouble moving forward, because then the Federal Reserve will have to make a very difficult choice between starting to control the unemployment rate and make sure the economy doesn't go down or experience some type of downturn, or of course continuing to rein in on inflation and bring it back lower. So hope you all enjoyed this video and a complete update on the markets here. Make sure to drop a like and subscribe to the channel if you're just joining us for the first time. Again, link's going to be down below if you want to join, of course, be a part of our MoneyVest community, get access to this entire platform. Again, we're going to be adding a lot more features over time, so you will have access to amazing analysis and data points in the future as well. So as always, happy investing, and I'll see you all in the next video.